Steve Peterson here with Infinity Investments, and welcome to our channel where we talk all things commercial and investment real estate. In today's video, we're going to be talking about developing your tax-advantaged real estate investing plan. And what I mean by tax-advantaged investing plan is structuring in to your investment plan ways to defer, to minimize, and to make sure you're not overpaying in capital gains taxes and ordinary income taxes as a very important part of your investment plan. Now, many financial planners will tell you that capital gains taxes can be one of the biggest, eaters of wealth, if you will. And we all know nobody wants to sell a property and pay these capital gains taxes ideally. The issue that I see with a lot of investors out there is that we don't properly plan for this. And this is why I'm doing this video, because I think as you put together your investment plan, as you put together your investment strategy, there's some key pieces that you should have as a part of that to make sure that you have the most tax advantage strategy possible. Now, particularly when you're developing your investment plan, when you're developing your investment criteria, what you should be considering is tax ramifications on your rates of return that you're looking to earn, through your investing activities. I'm a CCIM, that stands for Certified Commercial Investment Member, and in that course, it's a commercial real estate designation. In the course curriculum, every time we're calculating rates of return, we calculate both before and after tax rates of return. That's a standard in the CCIM curriculum. What I find though, in broker world and investor world and wheeling and dealing world, a lot of times we don't look at that. We're just looking at, okay, here's the cap, here's the cash on cash. We're not even looking at, the ramifications of tax in our rates of return in terms of projections. So number one, we've got to be able to do that, right? You've got to be able to figure out and calculate what the tax impact is in your rate of return over the life of the holding period of one property, but also over the career of over your investment career. That's very, very important, because if you're not paying attention to that and you're in and out of deals and you're just paying a bunch of money on your income tax on your cash flow, you could be missing out on hundreds of thousands of dollars, if not millions of dollars of wealth that you can create by doing things like a cost segregation study, for instance. A cost segregation study, I'm not gonna get into the details of it, but it's a financial accounting process where a company comes in and does a study on your building and figures out what things can they use, what costs can they segregate in order to accelerate your depreciation schedule. So in other words, if you accelerate your depreciation schedule, now you can minimize your tax liability from an income tax standpoint on your property's cash flow. Very, very clever way to increase a property's cash flow right off the bat, especially if that property has had significant renovations done or development done on it recently. And that's a really, really good ROI enhancer. Now, double-edged sword of cost seg studies is that when you sell, now you have the accelerated depreciation schedule during the operation, will end up in an increased depreciation recapture that you'd have to pay. Now, if we're doing 1031 exchanges though, and that's a part of our plan, that's an intrinsic part of our plan. Hey, we're gonna swap till we drop. A cost seg study, could be a great thing to do because you're not gonna get hit with that, with that depreciation recapture. So that's just a little thing that to think about as we're setting up our investment plan. Now, you also want to find ways to keep your money moving without paying capital gains. Now, you guys know me, I'm always talking about 1031 exchanges, right? And as a broker, we love 1031 exchanges for our clients. But a lot of successful real estate investors can pull out cash through a refinance, take that cash, and then go reinvest, right? It's a basic one-on-one, right? And a lot of times people miss it though, or people don't do it the right way, right? Especially if we're talking commercial investment real estate, You have to take these things into consideration, all right? And when you want to refinance, the prepayment penalty or the yield maintenance, if you will, on bigger loans can be a killer if you go to sell it at one point down the line. So you have to have a good plan going in and say, I'm going to refinance, but I'm going to set this refinance up in a way it's not going to hurt my property, but it's going to help me take out tax-free money to go buy more real estate. And so what my point is to put that into your plan up front so that while you're wheeling and dealing, you got different options of how you're going to do and what you're going to do. Okay? And 1031ing is a great way to move up, but you can take out some cash via refi and then go do another deal. Now, speaking of 1031 exchanges, you all know that's one of the great accelerators of wealth in the United States. 4 greenhouses, 1 red hotel, right? Monopoly money. It's a great way to move up. And you may have properties that you say, hey, I love this one. I'm going to refinance. I'm never selling this one. But if you own enough properties, there's always that one bad apple where you're just like, man, these tenants are stressing me out. Or, if it's retail, I don't know what's going on with the traffic count or office. It's just had bad luck on tenants. And you're like, you know what? We want to sell this one. Or it's a property where it just shot up in value and hey, I could really maximize if I sold this property. My ROE, my return on equity is 1 or 2%. But if I sold this and I got a 4 cap rate, I can triple my cash flow, right? So when it's time to do that, that's what we want to do, our 1031 exchange. And when doing exchange, you want to be very calculated about it. We've got a 1031 exchange, a 1031 success checklist that we develop for our clients. And you should take a look at it. And it guides you, a 9-step checklist on when you're doing an exchange, how to execute that exchange successfully. Because the biggest challenge in 1031 exchanging is finding a better asset for your replacement property. And notice what I said, a better asset, not just another property. When you're doing an exchange, the key is to find a better asset. There's a guy, that guy, Ron Ricard, IPX 1031, and every time he speaks, I think that's what he says, is the point of exchanging is for you to find a better asset, not to defer tax. The deferral of taxes is the cherry on top. It's what makes it so great. But the purpose is to take your one asset and go get a better asset. And in doing so, it's a calculated process. One that which you need a team to work with you on to thoroughly make sure, especially in a hot market like we're in now, to make sure that whatever that acquisition is, it fits your specific criteria and it puts you in a better investment position than your last asset did. Very, very important to do that. Now, another thing to think about is opportunity zone funds. That's a new idea as of 2017, but it's another great way to defer taxes if you are selling an asset. And the great thing about opportunity zones is, you can structure the fund yourself. You can invest with the fund, but you can structure a fund. You don't have to structure a $100 million fund. You can structure a fund just to take your gains and reinvest them the way that you like. And you can do that in a very, very tax advantage way. And that's why I'm doing this video, because we're at a point in the market where there's a lot of people making capital gains. And what I see is just not enough diligence about making the next step. And that's one thing that I want to just make sure that I'm putting content out there to you sophisticated investors who are in this situation, to make sure we can plan this thing out and that we're not doing fire drills looking for property or just trying to defer gains. Very, very important. And the last thing I want to talk to you guys about in terms of having a tax advantage real estate investment plan is understanding when you exit, the power of creative financing. All right. And I think that we're going to see in 2022 more creative finance deals that we've seen in a long period of time. And the reason I think that is because we are in a rising interest rate environment. So the cost of the money is going to be more. And I think we'll see more situations where sellers are saying, hey, come on, assume my mortgage. Come on, take over my mortgage subject to. Come on, do a wraparound mortgage. Right? And that could be advantageous to the buyer because the rates in the market are higher, where the seller's rate may be lower. So now you've got a little bit of a value add just by making that move. Also, with the rise in interest rates, transactions may be more difficult to put together. And in that environment, what I've seen several successful sellers do is carry financing, do master lease options to buy. All right, like I mentioned, wraparound mortgage, traditional first carried and second, first and second deeds of trust. These are ways of selling your property in a difficult time, or selling your property, maximizing the price, but also minimizing your tax liability and receiving income from a property that you already know a lot about. Okay, sometimes when you're exchanging, the whole point is to acquire a better asset. Sometimes you can't find that better asset. Why not shift your management responsibility as an owner and become the lender and just receive interest income on a property that you already know about? That can be a very powerful way for you to exit your asset, right? And doing so in a tax advantage way. And these are just a few ideas that you can utilize as you're out there investing in a changing interest rate environment, in an inflationary environment. And I think the key that I keep teaching and preaching and stressing to my clientele and people in my world, you guys online, is that we got to operate from a plan. And the plan should be tax advantaged, right? If you're a sophisticated investor, you should have, or you probably already do have, a team that's helping you out. If you're looking for a team, why don't you book an appointment with us and let's put together your tax advantage plan. All right. If you've got your team, or you're looking learn more about exchanges, download our 1031 Success Checklist, and let's stay in contact and work together. Make sure you're operating with the plan, and make sure that tech plan is tax advantaged from the very beginning, so that you can build wealth and not have Uncle Sam and Uncle Gavin here in California eat at your wealth on a consistent basis. I hope this helps you. If it does, subscribe, like, share with friends, comment, and until the next video, best of success in your investing career. Peace.